Hey, good morning, everybody in 110. We're about to go into chapter 11 on purchasing. It's sort of the mirror image of chapter 10, which was about accounts receivable. Chapter 11 now is about the opposite side, the purchasing side. So let's take a look and see what we can learn today. Okay, I hope you see the slide. I'm assuming you do. Accounting for purchases and cash payments. In the prior chapter, we were talking about debiting accounts payable. I'm sorry, in the prior chapter, we're talking about debiting accounts receivable, crediting sales. Here, we're debiting purchases and crediting accounts payable for the most part. So it's kind of just the opposite with a few exceptions. Merchandise purchase transactions. I think we know what that is. You're buying merchandise to be sold later. And they're talking about different forms involved: a purchase requisition, a purchase order, a receiving report, and a purchase invoice. Now, on the test, they like to put these different reports in the form of true false questions. So let's try to understand what each of these forms is. A purchase requisition is usually a form that anybody can fill out. It's just a request to buy something. You work you work in an office as an accounting clerk or something, and you think that your computer is malfunctioning and you'd like a new computer. Well, you can fill out a form called a purchase requisition. You give it to your boss, and it'll say, "Boss, can you buy me this computer, please? My old one's not working very well." If he approves it, he'll turn it over. He'll turn a copy of it over to purchasing, and they will go and buy that machine for you. And when purchasing buys the machine, they will create what's called a purchase order. The purchase order is the formal contract between the buyer and the seller. The purchase order tells the seller exactly what the buyer wants in terms of quantity, pricing, freight terms, and some other things. And there is a purchase order. This person wants three each of these different mechanical parts, $760. The next form is the receiving report. When the goods have come in, there's somebody in your warehouse or in the back of the store who's going to sit down and actually write up what was received, and that'll be done on a receiving report. And of course, we're going to get the bill in the mail. That's called the invoice, the purchase invoice. Seller calls it a sales invoice, buyer calls it a purchase invoice. And before the payment is made, and accounting departments do this, they compare the purchase invoice with the requisition, the purchase order, and the receiving report, and make sure they're all in sync. Only when they are will they make the payment to the vendor. Checking all documents is an example of exercising proper internal control. Purchase invoice. Cash discount. Well, in the prior chapter, we called it a sales discount. That's the 210 net 30. The buyer calls it a purchase discount. Now, don't get confused with a trade discount, okay? This is what a trade discount is. A company has a catalog of all of their parts and their prices. And in the catalog, it might say 30% off everything on this page. Well, you don't put that 30% discount into your financial statements. You just go with whatever the price is that he's charging you, okay? It's a reduction from the list or catalog price offered to certain classes of customers. Trade discounts represent a reduction in the price of the merchandise, and you don't enter it. It's not an accounting function to enter that. The buyer and the seller both record at the net amount after the trade discount, okay? And here's an example of a trade discount. You got a bill from somebody and they said it's $760, but I'm giving you a 10% discount. You work with the 684 on the bottom, not the 760, okay? Describe and use merchandise purchases accounts and compute gross profit. What are our purchases accounts? Well, we had sales in the prior chapter. Now we have purchases. In the prior chapter, we had sales returns and allowances. Now we have purchase returns and allowances. And now we have purchase discounts instead of sales discounts. And freight in is the cost to bring the product into your store, the cost of the trucker, the UPS charge or whatever, and that's going to become part of your inventory. So what they're showing us here are expenses. Purchases are expenses. A purchase is an expense. It's a cost item. So we have purchases, but then if we return something or we take a discount, we never credit purchases. Remember what I said about 100 times last chapter? You never debit sales. You never debit sales. You never credit purchases. Never, never do you ever credit purchases. But we have to reduce the purchases, and we do it not by crediting purchases, but by crediting purchase returns and allowances and purchase discounts, okay? They are contra purchase accounts married to purchases. Freight in is an expense that's part of the cost of the inventory. Purchases account used to record the cost of the merchandise when you buy it. This account is debited when the merchandise is purchased, and you never credit it, never. We don't count the closing process. That's different. You never credit purchases. And here's a simple example. They bought something for cash for $100. Look at the journal entry. We debit purchases for $100 and we credit accounts payable. Now, what about a return? We are returning something. We are the customer returning something. Well, we know we can't credit purchases, but what we can credit are purchase returns and allowances. It is a contra cost account with a normal credit balance. So let's take a look at it. We returned $200 of defective material. We debit accounts payable, of course, because we don't owe the $200 anymore. And we credit purchase returns and allowances, okay? Assume that the same merchandise is retained, but the supplier gives us a break of $45 because of defects, okay? Assume that the same merchandise is retained, but the supplier grants a price reduction of $45 because of defects. This is an example of a purchase allowance. We were ready to return it, but the seller said, look, why don't you keep it? I'll take $45 off the price. So that's a purchase allowance, what we're seeing here. Now, let's get back into our purchase discounts. Contra purchase account used to record cash discounts allowed on purchases. The account is credited for the discount granted by the vendor for prompt payment. The account is debited only during the closing price. You never debit these things. Merchandise is purchased for $100 on account with credit terms 210 net 30. Accounts payable is debited for the entire amount of the purchase. Cash is credited for the actual amount paid. And now they're showing you the payment of the bill. How much did we owe to the vendor? We owed $100. So we're going to debit accounts payable for $100. A 2% discount is a $2 purchase discount, and the difference in cash, $98. In other words, we gave up $2 to encourage prompt payment of the invoice. Freight in. This is an adjunct purchase account. Just think of it as an expense that's going to end up in the inventory calculation. We debit it for transportation charges. It's an expense. FOB. I had a lot of fun with FOB in my 230 class on their last test. Let's try to understand this a little bit. There'll be a question or two. Free on board, FOB shipping point, FOB destination. Free on board shipping point simply means, let me back up. FOB, free on board, means the exact point in time where title to the goods changed. If you ship something FOB shipping point, that means that the seller gets rid of it immediately. FOB shipping point means that the buyer owns those goods as soon as it leaves the seller's store. So the buyer is responsible for the freight charges, and the buyer owns it as soon as it is shipped. So you shipped to me from Santa Barbara $500 worth of books, and you put those books on the truck, and the truck left the school. As soon as the truck left the school, I own those goods. I have to pay the freight. My insurance company is responsible, okay? And freight charges can be listed on the invoice from the customer, from the seller, or it could be a separate freight bill. Either way, you've got freight in. FOB destination is different. The seller pays for the transportation charges. Seller owns the items until it's delivered. FOB destination, that truck of books coming to my location is not my responsibility, nor do I own it until it arrives. If that truck had an accident outside of Newark, New Jersey, where my store is, then you are responsible for it. So the free on board is the point in time where ownership changes from the seller to the buyer, and it can be a strategic thing to use, depending on what kind of arrangements you might have with a bank. You might want to put some inventory into your system to generate some borrowing power. So FOB, try to get a good understanding of that. Freight example. Merchandise was purchased for $400 plus freight. Okay, well, here's our entry. We got a bill from the vendor, and the bill had $400 in purchases, and it had a separate line item, $38. So the total we owe the vendor is $438. We debit purchases for $400, and we debit freight in for $38, and that makes up the $438 amount that we owe. Now, what they're showing you here is the same transactions, but this time we got the freight bill separately from the freight company and not from the seller. So here we're just going to take the seller's invoice and debit purchases, credit accounts payable, and do the same thing with the freight. Debit freight in, credit accounts payable. It's the same impact as over here. The only difference is we got two different documents to record. Gross profit. What's gross profit? Gross profit is net sales minus cost of goods sold. Net sales minus cost of goods sold, also called cost of merchandise sold. Gross profit. Compute gross profit from what you see here. Well, we know it's going to be net sales minus cost of goods sold. Look at all this information we have here, though. Oh my goodness, how are we going to figure this out? Well, welcome to the world of the new long income statement. Step one, compute the net sales. Net sales equals sales minus sales returns and allowances, sales discounts, and credit card fees. Okay, so from that information, we can get the net sales. I see sales at 201,500 minus 1,200 minus 1,000. Now we have to compute the cost of goods sold. And this is a longer transaction, a longer calculation. So let's take a look. We have to come up with what are called the goods available for sale. And that's going to be the beginning inventory plus the cost of all goods purchased. So let's go back up here. We have a beginning inventory of 26,000 they're showing us. We want to add 105,000 for purchases. We want to subtract 800 for returns and allowances, subtract 1,000 for purchase discounts, and we have to throw in some freight too. Okay, you have to add in the freight. When you do that, you get what's called the cost of goods available. Beginning inventory plus purchases equal a number that represents the most you could have sold. That's the most you could have sold. What you had at the beginning of the month plus what you purchased during the month. That's the most you could have sold. That's the most available for sale. It's called cost of goods available for sale. And what we have to do then is subtract the ending inventory, because what's in cost of good available for sale at month end is either going to be sold, in which case it rolls up into the cost of goods sold calculation, or we still have it in inventory, in which case that cost has been moved into the ending inventory. So the first step was net sales. Next step was available. Now the cost of goods sold. All you do is subtract the ending inventory from the goods available, and you get that 111,500. And now you can do the gross profit. Gross profit minus net equals net sales minus cost of goods sold. A better way to say it is net sales minus cost of goods sold equals gross profit. And take a look at the calculation here. This looks pretty difficult, huh? But divide and conquer, it's not too bad. It's not too bad. Think of it this way. You have to figure out your net sales. Well, we know how to do that. It's going to be our gross sales minus the sales returns and allowances and the sales discounts, gives us that. We know we have to come up with the cost of goods sold. And we know that the cost of goods sold is the beginning inventory plus purchases minus any returns and allowances or discounts. We can call that net purchases. We add freight in. That's the amount available for sale. Cost of goods available for sale. Okay. We had 25,000 in the beginning. We purchased another 103,500. So we now have 129,500. We ending inventory they gave us was 18,000. We subtracted them out, and that becomes the cost of goods sold. So have this screen in front of you, or take a picture of it, have it on a piece of paper when you're doing your homework, because you're going to struggle through this a little bit until you get the hang of it. And it's really not that bad. Like I say, divide and conquer. Get your net sales, then get your beginning inventory plus purchases, subtract that ending inventory, and you've got your cost of goods sold. So our net sales were 199,300 minus cost of goods sold equals $87,800. The accounts payable ledger. Well, we're experts in this. Accounts payable ledger, just like you had an AR ledger, it's a subsidiary ledger that supports the general ledger number. The general ledger number for accounts payable is just one number. One number. It's a balance, $1 million. The auditors come in and they say, who owes you this million? Who do you owe this $1 million to? You would hand them this book, the subsidiary ledger. It looks like a general ledger, and it carries, instead of having folders like cash, accounts receivable, it's got a folder for each customer showing the activity and the balance at all times. So here we have some purchases, and let me just take a quick look here, double check. Yeah, these are all the same. They purchased merchandise for $3,000. There's no sales tax or anything. So what happened? There's our journal entry. Debit purchases, credit accounts payable. That shouldn't be too tough. We know how to do that. Now they're showing us how to post it into the general ledger. And we know how to do that. We are experts at that. There's our general ledger. Here is our journal entry. We debited purchases 3,000. We bring it down 3,000, and we add it to the prior balance of 37,400. We have a sales to Mr. Ellsworth. We bring that down here, and Ellsworth has now gone up to 43. So we have one sale going to this guy here, Blakely Cycle, and the other one goes to Ellsworth. We know how to do that. Posting to the accounts payable ledger is just as easy. It's the same exact format. So here, we just showed you Mr. Ellsworth and Blakely being posted to the general ledger. Here you're posting to the accounts payable ledger. So each folder in the accounts payable ledger is a different person. So the auditors come in, they want to know how much is in accounts payable. You show them the number. they say, well, who owes you this money? And you come over to your ledger. You just bring the payment over. If there was a sale, there would be a debit to that. Accounts payable. Or rather, that is a sale. Debit would be a payment. Posting purchase returns. We do that the same way we post anything else. Assume that Sunflower returns $200 of merchandise. It's going to be put into the accounts payable controlling account, otherwise known as the general ledger, and also to the subsidiary ledger. So let's take a peek. Returned $200. When we return something, it means we don't owe the accounts payable anymore, which is why we can debit it. We debit accounts payable and we credit purchase returns and allowances. So we debit accounts payable, we credit purchase returns and allowances, and we also need to bring it over to our accounts payable ledger. We owed 53, this person owed us 5,300. Now they return 200, so we're down to 5,100 in collectible payable accounts payable. Hey, we made some payments. One was for 4,800 made on account, and the other one was with a 1% discount. So take a look here. Anytime you're paying off accounts payable, you're debiting accounts payable, in this case for $4,000 and crediting cash. Here, we're debiting accounts payable for the entire $8,700, but we're able to take a 1% discount of $87. So the cash amount is the difference between the two, the $8,613. And again, they're just showing us how to post. And I know we know how to do this type of thing. We post the return right here and over here. That's the payment going right there. We paid 4,800, balance down to zero. We paid 8,613, but that covered 8,700, which closes out the accounts payable. And then we want to prepare a schedule of accounts payable. And the only thing the schedule of accounts payable is a list of all the people to whom we owe money. We owe Blankley 3,300, Ellsworth 25, Milwaukee 800, etc. And Rams Design. And that's all it is. It's just a list of all your vendors and how much you owe them. Just like you have an accounts payable listing, you have an accounts payable ledger. All right. And of course, keep in mind that $11,900 there that you see as a total should be the balance of accounts payable in your general ledger. Accounts payable, the balance is 11,900. You want to know who owes you the money, you go to your detailed ledger. And here's where you see the different parties who owe you the money, okay? I'm not going over payroll, finding payroll errors. We've been through that. And we're not going into the net price method of recording purchases. So that is the end. That is the end of our discussion today. It was a fairly short one, but I think you'll see that this chapter and chapter 10, you study them together and it'll come through for you, okay? So I guess I'll call it quits. We didn't have any visitors, huh? Let me double check. I'm all by myself here. Oh my goodness, nobody came to class today. But that's all right, as long as you're keeping up with the videos, okay? So I'm going to close it down, and I'll hope to see some of you anyway next Tuesday when we go into chapter 13. We're skipping chapter 12 right now. Talk to you later.